Alright, listen up, let's talk about hedge funds. You hear the term thrown around all the time, right? It sounds complicated, mysterious, maybe even a little scary. But don't you worry, because Papa Kramer is here to break it down for you. A hedge fund is basically a private investment partnership. Think of it as an exclusive club for wealthy investors. They pool their money together and give it to a professional manager. This manager, the big shot, has one job and one job only: to make as much money as possible no matter what the market is doing. Whether the market is going up, down, or sideways, these guys are trying to print money. That's the name of the game, folks. Now, why are they called hedge funds? It's because they were originally designed to hedge their bets. That means protecting against losses. If you think a stock is going down, you can bet against it. That's called shorting. These funds use all sorts of complex strategies to try and make a profit while managing risk. They aren't just buying stocks and hoping for the best like your average Joe. No, no, no. They are playing a different game entirely. They use derivatives, leverage, and all sorts of financial wizardry to get an edge. They are the financial commandos of the investment world, using every tool in the arsenal to win. These funds are important, people. They are massive players in the global financial markets. They move billions, sometimes trillions of dollars. Their actions can influence stock prices, currencies, and even entire economies. When a big hedge fund makes a move, the whole world watches. They provide liquidity to the markets, meaning they help make it easier for others to buy and sell securities. They are often the first to spot new trends or uncover companies that are in trouble. They are the sharks in the water, keeping everyone else on their toes. Love them or hate them, you can't ignore them. So, to put it simply, a hedge fund is a high-octane, actively managed investment pool for the big money players. It uses sophisticated strategies to aim for high returns in any market environment. It's not for the faint of heart, and it's certainly not for your retirement savings account. It's the Wild West of the investment world, where fortunes can be made and lost in the blink of an eye. But understanding them is crucial if you want to understand how the real money works on Wall Street. Stick with me, because we're just getting started. Booyah! Now let's get ready to rumble. In one corner, we have the hedge fund, the aggressive, go-anywhere gladiator. In the other corner, we have the mutual fund, the reliable, steady workhorse of the investment world. A lot of people get these two mixed up, but they are as different as night and day. A mutual fund is what most people are familiar with. You buy shares and your money gets pooled with thousands of other investors to buy a diversified portfolio of stocks, bonds, or other assets. It's regulated up to its eyeballs by the SEC, which means there are a lot of rules they have to follow to protect you, the little guy. Hedge funds, on the other hand, play by a different set of rules. Because they are private partnerships and only cater to wealthy investors, they have way more freedom. They are lightly regulated. This means they can invest in almost anything they want: stocks, bonds, currencies, real estate, private companies, you name it. They can also use strategies that are off-limits to mutual funds, like using a lot of borrowed money or leverage to amplify their bets, or short-selling stocks to profit from a price decline. This flexibility is their superpower, allowing them to be nimble and aggressive in their quest for profits. Think about transparency. A mutual fund has to tell you exactly what it owns every single quarter. It's like an open book. You can look under the hood and see every single stock and bond in the portfolio. This is great for transparency and helps you know what you're paying for. A hedge fund? Forget about it. They are notoriously secretive. They guard their investment strategies like they're state secrets. They don't want you or their competitors knowing their secret sauce. This lack of transparency is a double-edged sword. It protects their strategies, but also means investors have to have a huge amount of trust in the fund manager. Finally, let's talk about goals. The main goal of most mutual funds is to beat a specific market index like the S&P 500. Their performance is relative to the market. If the market is down 20% and the fund is only down 15%, they call that a win. A hedge fund manager would get fired for that. Hedge funds are all about absolute returns. Their goal is to make money, period. They don't care what the S&P 500 is doing. They want positive returns in bull markets and bear markets. It's a much higher bar, and it's why they can charge such crazy fees, which we'll get to later. So you're thinking, Kramer, this sounds exciting. Where do I sign up? Hold your horses. This isn't like opening a brokerage account and buying some Apple stock. Hedge funds have a very exclusive guest list. There's a big velvet rope at the door, and a tough-looking bouncer, in this case the government, is checking IDs. To get into this club, you need to be what the Securities and Exchange Commission, or SEC, calls an accredited investor. This is a fancy term for someone who is wealthy and sophisticated enough to understand the risks, and frankly, to afford to lose their entire investment without it ruining their life. What does it take to be accredited? Well, the rules are pretty specific. Generally, you need to have a net worth of over $1 million, not including the value of your primary residence. Or you need to have an annual income of over $200,000 for the last 2 years, or $300,000 for a couple, and have a reasonable expectation of the same for the current year. There are also new categories for people with certain professional certifications or knowledge. The government's thinking is that if you have this kind of money or expertise, you don't need the same level of protection as the average investor. You're a big boy or girl who can handle the heat. But wait, there's an even more exclusive level. It's called being a qualified purchaser. This is the VIP section of the VIP section. To be a qualified purchaser, you generally need to have at least $5 million in investments. Many of the biggest and most successful hedge funds will only accept qualified purchasers. Why? Because funds that only have qualified purchasers are subject to even fewer regulations than those that accept accredited investors. This gives them even more freedom to operate and execute their complex strategies. It's all about creating a playground for the financial elite where they can take big swings. So, why all the exclusivity? It's really about protection. Hedge funds are complex and risky. They use leverage, which can magnify losses just as easily as it magnifies gains. They can be illiquid, meaning you might not be able to get your money out whenever you want. There are often lockup periods where your capital is tied up for a year or more. The SEC wants to make sure that only the people who can truly afford to take on these risks are the ones who are exposed to them. It's a barrier to entry designed to keep the average retail investor out of harm's way. Don't take it personally, they're just trying to protect your nest egg. Okay, so how do these geniuses actually try to make all this money? It's not just one single trick. They have a whole playbook of strategies, and the best managers are masters of picking the right play at the right time. One of the most common strategies is called long-short equity. This sounds complicated, but the idea is simple. The fund manager buys stocks they think will go up, that's the long part, and simultaneously sells borrowed stocks they think will go down. That's the short part. The goal is to make money from their good picks, while also hedging their bets against a market downturn. If the whole market tanks, their shorts can make money and offset the losses on their longs. It's a classic. Another big one is global macro. These managers are the James Bonds of the investment world. They make big bets on macroeconomic trends across the globe. They're looking at interest rates, political changes, currency fluctuations, and commodity prices. For example, if a manager thinks the Japanese yen is going to weaken against the dollar, they'll make a massive bet on it. If they think oil prices are headed to the moon, they'll pile in. These are huge directional bets that can lead to spectacular home runs or spectacular strikeouts. It takes incredible foresight and guts to be a macro trader. Then you have event-driven strategies. This is all about capitalizing on specific corporate events. Think mergers and acquisitions. When one company announces it's buying another, a hedge fund might buy the stock of the company being acquired, betting that the deal will go through at the announced price. This is called merger arbitrage. Other event-driven strategies might involve investing in companies going through bankruptcy or other forms of restructuring. The manager is an expert at analyzing the legal and financial details of these complex situations, trying to find mispriced securities where they can squeeze out a profit. Finally, there are quantitative or quant funds. These are the rocket scientists of Wall Street. They use powerful computers and complex mathematical models to identify trading opportunities. They might be looking for tiny, fleeting price discrepancies between related assets or using algorithms to predict short-term market movements. These strategies are often high frequency, making thousands of trades a day. The human element is minimized. It's all about the algorithm. It's a world of pure data, where speed and computational power are everything. The playbook is deep, and the best managers are always inventing new plays. Now let's talk about the cost of entry and the risks. Access to these brilliant minds and their high-octane strategies doesn't come cheap. Not by a long shot. Hedge funds are famous for their fee structure, commonly known as 2 and 20. This means the fund charges a 2% management fee on all assets under management every single year, whether they make you money or not. That 2% is just to keep the lights on. Then they take a 20% performance fee, which is a cut of any profits they generate. So if they make you a 10% return, they keep 2% of that as their cut. It's a hefty price, and it means the fund has to perform incredibly well. just for you to beat a simple index fund after fees. The risks are not to be taken lightly either. We've talked about leverage. Using borrowed money is like pouring gasoline on a fire. It can lead to incredible returns, but it can also wipe you out in a hurry. A small market move in the wrong direction can lead to catastrophic losses. We've seen it happen time and time again, where a famous high-flying fund blows up spectacularly because a leveraged bet went wrong. This is not buy and hold investing, this is high-stakes poker, and sometimes you can lose your whole stack of chips. You have to be prepared for that possibility. Another major risk is liquidity. Unlike a mutual fund or a stock that you can sell any day the market is open, your money in a hedge fund can be tied up for a long time. Most funds have lockup periods, often for 1 to 2 years, during which you cannot withdraw your initial investment. After that, you might only be able to take your money out quarterly or annually, and you have to give them notice. This is called a gate. If too many people want their money back at once, the fund can slam the gate shut and prevent you from cashing out. This is to prevent a run on the fund that would force them to sell assets at fire sale prices. So why are they still so important? Despite the high fees and massive risks, hedge funds play a vital role in our financial ecosystem. They are a force for what we call price discovery, helping to ensure that asset prices reflect their true value. By shorting overvalued companies, they act as a check on corporate hype and mismanagement. They provide liquidity and take on risks that other investors can't or won't. They push the boundaries of financial innovation. They are the ultimate expression of active management, constantly searching for an edge. Understanding them is key to understanding the flow of big money in the world. Now you know the deal? Go do your homework.